Today, we are putting on our private equity director hats to dive into an absolutely brilliant masterclass briefing on graduating from an independent operator to a true institutional partner. We're going to unpack exactly how to build the ultimate asset wrapper, packaging your real estate portfolio so it scales efficiently and attracts serious capital.
Quickly, here's our roadmap to true scale. We'll be covering architecting the wrapper, building a TTM data vault, structuring transferable contracts, and finally, unlocking the capital key using DSCR. Let's get right into it. Looking at a gorgeous, high-value property with a waterfront view, it's super tempting to think that scaling up just means buying more of them. But here is the reality check from the briefing. True scale is absolutely not about babysitting individual properties. It's about optimizing the asset to create a turnkey enterprise. You want something that external capital partners can look at, instantly analyze, and confidently fund. We are talking about systematically building an exit-ready enterprise right from day one. And that brings us to asset governance. This is exactly how you escape what the briefing perfectly calls the physical entropy layer. You know what I mean? All those tiny, daily, reactive frictions and maintenance headaches that just bleed your margins dry. By proactively optimizing the entire asset for peak financial yield, you completely shift your positioning. You go from being a tired landlord just reacting to broken pipes to a highly resilient institutional investor fiercely protecting the bottom line. It's a total game changer for your operational efficiency. All right, Section 1, the TTM data vaults, and consolidating your verified performance. To actually build that vault, we rely on TTM, or trailing 12 months. This is an absolutely essential metric. It gives you this highly accurate, seasonally adjusted view of the asset's financial health. By looking at a rolling 12-month window, you completely smooth out any short-term seasonal volatility. And trust me, this gives institutional allocators the exact, clear-eyed, verified view they demand before they even think about writing a check. The formula itself is beautifully simple. It's your latest fiscal year plus your current year-to-date minus the prior year-to-date. Boom. Having this pure data consolidated in cloud-based repositories is literally what unlocks accurate, localized cap rate models and dynamic pricing logs for your portfolio. When you have pristine, trackable data like this, that is exactly what puts your deal at the absolute top of a lender's pile. Moving right along to Section 2, the contractual engine, and how we structure management rights. If you compare a standard basic co-host setup to an institutional propco/opco model, the difference in your risk exposure is night and day. Simply put, using a master lease agreement safely and completely separates the actual real estate ownership, the propco, from the daily operational execution, which is the opco. This operational shield completely de-risks your income stream, meaning your operations are never vulnerable during a major transition. To actually make that model work, the briefing heavily emphasizes drafting transferable fractional management agreements. You absolutely need clear entity assignment clauses and strict arm's-length internal revenue standards. Why? Because this ensures your operational wrapper stays completely intact, with zero operational friction the moment new capital partners enter the deal. You are completely eliminating the concentration of operational risk. Which brings us to Section 3, the capital key, maximizing your DSCR. DSCR stands for Debt Service Coverage Ratio. This is the pivotal criterion for banks. It proves with hard data that your dynamic revenue streams comfortably and consistently exceed your baseline debt obligations. The really actionable takeaway here is that by systematically minimizing your operating expenses, your OPEX, through that proactive asset governance we talked about earlier, you directly boost this ratio. You are aggressively enhancing your overall creditworthiness. I absolutely love geeking out over these metrics. Look at how the project IRR interacts with interest rates on this heat map. Focus on that safe zone right there in the top corner. When you augment your DSCR by ruthlessly cutting out operational friction, you mathematically prove to lenders that your revenue is completely unshakable. That proof is what empowers you to qualify for highly preferential interest rates, even when the broader markets are fluctuating. There is a fantastic quote here from Global Prosperity that hits the nail on the head. Increasing NOI through the systemic minimization of OPEX directly enhances the asset's creditworthiness in the eyes of banks and private lenders. It perfectly sums up the entire strategy. Eliminating that invisible margin bleed is exactly what makes your portfolio utterly irresistible to institutional lenders. And the best part is, you can drive that pure revenue up even further.
By combining this strict financial rigor with luxury amenity stacking, think premium pools, curated beachfront experiences, or in-home concierge services, you create a massive competitive moat. High net worth guests are usually price insensitive to these amazing add-ons. That means you're generating incredibly high margin premium revenue without adding any extra physical wear and tear to the property itself.
Let's quickly recap this actionable blueprint for assembling your portfolio wrapper. Number 1, consolidate your verified TTM data rooms. Number 2, draft those transferable management agreements. And number 3, maximize your DSCR to unlock prime joint venture financing. Executing just these 3 steps elevates you completely out of the commodity rental space and into institutional portfolio packaging at the absolute highest level. So I want to leave you with a final, slightly provocative question. Is your portfolio truly a turnkey enterprise asset class, or are you honestly still just managing commodity properties? It is time to step up to institutional-grade asset governance. Thank you so much for joining us for this explainer. Now get out there, run the numbers, and build that ultimate asset wrapper.